Hello everyone, I'm Elvis Picardo, Senior Portfolio Manager with Luft Financial, IA Private Wealth. As many of you might know, I'm part of the team here at Luft that looks after your portfolios and does the portfolio management. The topic of today's video is one that has been on all our minds for the past couple months, namely the Trump tariffs. These tariffs have injected tremendous uncertainty into the global economy and have triggered a surge in market volatility. Now, I'm not going to spend too much time on detailing the tariffs because they seem to change on a daily basis, but rather my goal is to let you know the steps that we have taken in recent months and that we continue to take on an ongoing basis to mitigate the impact of these tariffs on your portfolios, specifically on the downside. Since Canada sends about 75% of its exports to the US, there's little doubt that tariffs on Canadian goods going to the US would have a negative impact on the economy. Economists estimate that if the tariffs last for a while, it would reduce economic growth by 2 to 4 percentage points, wiping out growth and causing a mild recession in Canada. In addition, Canadian tariffs on US products and a weaker dollar would cause inflation to rise, and this combination of zero growth and rising inflation is called stagflation, which needless to say is not a good thing for the economy or the stock market. Tariff uncertainty is weighing not just on Canadian consumers, but on the US consumers as well. And in fact, recent US economic data has been softer than expected, and the risk of a recession in the US appears to be rising. Markets and investors had assumed all along that the tariffs were essentially a US negotiating tactic. So when they began factoring in the real risk of a global trade war, we saw a significant sell-off this week. So amid all the bad news, are there any silver linings? Actually, there are a few. So let's look at those now. The first thing is the Canadian economy is holding up quite well, all things considered. It ended last year with a 2.6% annualized increase in GDP, mostly driven by consumer spending. As well, the big 6 Canadian banks, which are a solid barometer of the Canadian economy, all posted solid results for fiscal Q1. So we should be able to withstand the initial tariff shock, especially if it's short-lived. Secondly, inflation pressures are abating in Canada, and this has enabled the Bank of Canada to cut interest rates at the fastest pace of all the major economies. The bank has already slashed interest rates by 2 percentage points since last year, and it could cut rates again next week. Thirdly, from a Canadian perspective, the US's bullying behavior seems to really have strengthened our resolve to deal with long-standing issues that have held back our trade and our growth. It's not a short-term fix, but issues like eliminating barriers to interprovincial trade, diversifying into other export markets, and unlocking our vast natural resources responsibly will surely pay off in the long run. Turning now to the US, this week there was a lot of chatter about the so-called Trump put. What this means is that if the US markets fall beyond a certain point, let's call it 10%, the tariffs might be delayed or, fingers crossed, taken off the table altogether. We've already seen limited evidence of it this week after the sell-off on Wednesday. Also in the US, the Magnificent Seven, which are Amazon, Alphabet, Apple, Meta, Microsoft, Tesla, and Nvidia, are suddenly looking more shaky than they have in months. Nvidia lost more than $500 billion in market value on a single day, Jan 27th, which was the biggest wipeout in history, after a Chinese startup named DeepSeek unveiled a low-cost AI model. As for Tesla, it has lost a third of its market value over the past month alone. Now, meanwhile, other US sectors like healthcare and consumer staples are doing well, reducing the concentration risks from the Mag 7 in the US. And also, markets like Europe and China are all outperforming the US, which is again positive from the diversification point of view. Finally, if a ceasefire can be cobbled together in the Middle East and between Russia and Ukraine, it would be market positive because it would sharply lower geopolitical risk. So although things look a little uncertain, we think one needs to tune out the noise and focus on the long term. So here are some steps that we've taken over the past 8 months to protect your portfolio on the downside. In January, we rebalanced your portfolios and really strengthened the fixed income sleeve by replacing some holdings with high quality diversified ETFs. We also took profits in a preferred income fund after it gained more than 25% last year. We increased cash held for periodic withdrawals like RIFs to 6 months by trimming positions right at the market top. And in November, we reduced exposure to the Max 7 by replacing the XLG ETF, which is the S&P 500 Top 50 ETF, with a broader multi-factor ETF. And in July 2024, we improved diversification and reduced volatility by replacing individual stocks with active ETFs. So let me summarize the result of these changes on your portfolios, because it really helps on the downside. The first thing is neutral asset allocation. We are smack in the middle of our target range for equities, which is where we want to be. For example, in our balanced growth portfolios, our equity target weight or allocation is 60%, which is neutral for such a portfolio. We don't really think it's advisable to go to the bottom of the range, like 50% or 55%, because of the upside risks mentioned earlier. And these could cause a market rally, such as a delay in tariffs, a reduction in tariffs, a ceasefire between Ukraine and Russia. These would all make the markets jump in the short term. The next point is adequate weight in fixed income. In our portfolios, fixed income has a 32% weight, which means that if interest rates decline as economic uncertainty weighs on growth, fixed income will rally and cushion part of the downside from equities. Next point, we have significantly lower exposure to the Max 7. In our balanced growth portfolios, this is less than 5%, compared with something like 8% for the benchmark. As well, the majority of our equity and fixed income sleeves are actively managed by top-tier managers, which is a really positive thing. And finally, we have near zero exposure to speculative investments like crypto and junk bonds. So what can you do with regard to your investments? The most important thing at a time like this is to focus on the long term. 10 years from now, this turmoil will just look like another obstacle that was eventually overcome. Despite all the negative developments over the past 25 years, like financial crisis, a global pandemic, wars, terrorist attacks, markets were at record highs just last month. But if you are getting nervous and the constant barrage of bad news is giving you sleepless nights, give us a call and we would be happy to help. That's it from me for this edition. Thanks for your time. Thank you for watching. Goodbye.